What is going on, you guys, and welcome back to another video on the channel. If you're new here, if it's your first time here, my name is Brandon, and we got a really quick, punchy video today. We're getting straight to it and actually commenting on a subscriber question that came in regarding dividends. Question being, yo Brandon, I do have a question if you appreciate to address it. Walmart is at a 1.84% dividend yield. It's getting almost as low as short-term, mid-term bonds. Question then becomes, why would you invest in a stock where it can still drop during a recession and not simply go buy some bonds if you're willing to accept that low yield? Which I just want to start off by saying, phenomenal question. Really good insight. Essentially saying when we're looking at a stock with a 1-2% yield, which are a lot of companies, right? We touch on companies all the time on this channel, some of my favorites that have a sub 2% yield. Why would I go out and buy that stock, take on that equity risk, take on the chance of it going down when I can get a very similar yield by going out and buying a risk-free asset, by going out and buying an interest-bearing asset such as a bond? So that's what we're addressing today. I have 4 points, 4 topics as to, I guess, a little rebuttal for that, and maybe just bring a little bit more insight into that. Point number 1 being that we have to keep in mind dividends do increase over time. So companies on, let's say, an earnings report, like on a quarterly filing, on a news release, or even an annual report, it's very common to hear that a company decides to actually increase, to actually bump up the amount of dividends that they're paying out. So you're right that, today, if you just look at it on a scope of today, you buy a share of Walmart, you buy a bond, very comparable yield. But if you're able to look out 5, 10, 20 years down the road, which is what we like to promote here, long-term investing, that same share of Walmart, let's assume Walmart's $100 per share and it pays a $1.85 dividend, so a 1.85% yield. Well, if next quarter or next year they bump that up by 15%, and then the year after that they bump it up by another 15% and another 15%, another 50%, next thing you know, that same share that you purchased for $100, you could be pulling in $2 dividends, $3 dividends, $5 dividends if you're willing to hold your investment out long enough. So that's what we would call the yield on cost. You paid $100 for that single share, and if they raise it, well, the dividend on that share continues to grow. So there's actually a really big potential for your dividends to increase over time, and that's why dividend growth investing is a very popular strategy, especially on YouTube. Everyone just all of a sudden seems to become a dividend expert now that these videos are trending all over the place. That's a side note. The second point goes without saying, and this could go either way, but obviously by purchasing the dividend stock, you have the potential, there's the chance for capital appreciation, right? The share price could go up. Now, of course, it could go the other way down, or it could go the other way. It could very likely go down, which could be a negative, but at least there's the chance for capital appreciation. Whereas with a bond, if you go out and buy a bond, you are very capped out. You're limited in terms of how much you're going to make. You know for a fact you're going to pull in this much income, and really your upside is there's a ceiling on that. With the stock, you got your dividend payments, and assuming you're buying a good stock, take Walmart for example. Well, along with the dividends, share prices appreciate all the time. Again, assuming we're talking about good companies here, but obviously you do have the potential. You're at least leaving the door open for your shares to increase in value and to actually make a profit off that capital appreciation with the dividend route. Point number 3 is involving taxation. And this is one that a lot of beginners don't even think, it just goes right over their head. They don't even factor in. But dividends, dividend income is actually taxed more favorably than interest income. So if you have a bond, the type of income you're receiving is interest. If you're holding a stock and you receive some income, that's a dividend. Now, of course, this only applies in a taxable account. So if you're using an RSP, if you're using a TFSA, an RESP, don't even worry about this. We're sheltered from tax in that case. But if you have overflowed, if you got more money and you're using a margin account or a cash account, this applies. Dividends are actually taxed more favorably, especially our Canadian dividends. They're subject to the dividend tax credit. You can actually gross them up. You can gross up your dividends and at least get a little break on the income that you're receiving relative to interest income. In fact, fun fact is that interest income from a bond is really the worst type of income you can earn from a tax perspective. You don't really get any breaks on that income. If you're looking at it, we got capital gains is the most favorable because we have the capital gains tax or the credit. We're deducting 50%. We're only including 50% of our gain. Dividends come in second because, again, we have the dividend gross up, in particular our Canadian dividends. And lastly, we just have our interest income, which is just taxed at our normal rate. And if you're like, what the heck is he talking about? I did do a complete video on taxes, stock market taxes in Canada. If you do want to search that one up on the channel, that'll explain everything you need to know there. But yes, taxation does factor in as to your decision as to why I should hold a dividend stock or why I should hold a bond. Dividends are taxed more favorably. Our final point, which is one that doesn't matter to me, but it definitely could if you're somebody that's really, really timely with your payouts, is that dividends, of course, are paid out on a quarterly basis. So every 3 months, you're going to be receiving a dividend payment, whereas a bond, those are typically paid out semi-annually, so twice a year. So again, not really a big deal for me, but if you like having that income constantly coming into your portfolio, I guess that is just another factor to think about. You got the quarterly dividends versus twice a year. Again, it doesn't really make a difference because you can just pull it out of your portfolio whenever you want. But those are just a few points that I had jotted down to address. Again, a really good question. This is a question that I asked myself when I was starting out, and I think it's a really wise question to think about that. Why would I do a dividend stock when I can go out and buy a bond? Hopefully this video provided some insight into just a couple reasons as to why. I'm not trying to convince anybody here what they should be doing, this or that, but at least just providing a little bit more insight into a few reasons why dividend stocks are better than bonds. I don't know about better. I mean, they both serve their own purpose. I think a portfolio should consist of both dividend stocks and bonds, but at least you know a little bit of the difference as to why you can make that choice. If you guys enjoyed today's quick video, give it a thumbs up and subscribe for more content. And of course, we do have our Investing Academy. If you are a beginner, if you're a Canadian that's looking to get started and you really want some help in learning this stuff, getting your account set up, the whole 9 yards, click the first link down below because we're working with Canadians every single day to go through this entire process and really just understand, what we're talking about in this video and just the entire investing field. But thank you guys for watching. I hope you enjoyed, and I'll see you in the next video.